我也没当时，因为开始还就是半天就才好，然后我到后面必须要用我自己在这工作大我，还有这个力量，会一点点多，结果他已经有劲。但是好像还有1个月。Oh wait, right here. You want to just sit like this? Yeah, yeah. Sorry. Sorry. Yeah. 不要开车吧。开车就可以了。
Okay, folks. Two quick announcements before I start. First is, it's good news, next week is spring break. The bad news is, if it's spring break, we're almost to the halfway point of the class. Crap is going to hit the fan right after you come back from spring break because everything is going to start to come due. On this project, it's already happening, right? So it's a mid-semester. Pick up your quiz when you get a chance. So, denial is not going to make the quiz go away. So not picking it up doesn't mean it doesn't exist. So for some people, that might be a redeeming feature. So pick it up, the score, check your score. In fact, make sure you check your score on the quiz. Make sure I have it screwed up on the grading. Check your score in Brightspace to make sure it matches the score on your quiz. Don't assume that there is no human error. As I said, because we're getting the midway point of the class, it's my job to remind you that if you want to get feedback on your intrinsic valuation, I need to get it by the end of this month. So if you haven't even opened up the spreadsheet, you might want to do it. I'm not saying you should work on it during spring break, but you need to at least get started on it. It's not going to get done on its own. So work on it. So today we're going to talk about that big number in every discounted cash flow valuation, the terminal value. It's a number where the most damage gets done in valuation because people do some really weird stuff. Okay. So today's start of the class test, I'm going to focus on some of the questions that are going to drive. So the first question, to get the terminal value of the company in year 5 or year 10, I'm going to give you 4 choices, and I want you to tell me the one choice you should never use because it doesn't belong in an intrinsic valuation. A liquidation value. Is that okay in an intrinsic valuation? In other words, you stop in year 10, you liquidate all the assets, you get cash flows. Hey, no problem with that. In fact, you know what kinds of companies you do it on? Declining companies, maybe private businesses where a lease runs out after year 10. Liquidation value is perfectly okay. How about stable growth models? Let's hope it's okay, because otherwise everything that you see in my book kind of breaks down after you get to the terminal value, right? So you assume a growth rate in perpetuity. Are you allowed to assume instead of a perpetuity, just that 15 years or 20 years of cash flows after year 10? In other words, a growing annuity? I don't see why not. It is a present value as well. I've kind of answered the one way you should never estimate terminal value, which is to use what's called an exit multiple. Bankers do it all the time. Almost every one of their DCFs, here's how they get the terminal value. They get EBITDA in year 10, multiply it by 8 times EBITDA, which they get by looking at other companies in the sector or the group, and come up with the terminal value. Why is that? Why should you never? If 80% of banking valuations do this, I want you to be able to explain to bankers why it shouldn't be done, because you're going to be on the other side of the table asked to do this. I know whether you want to bring this up with your managing director who thinks this is the way to get terminal value. But tell me what's fundamentally wrong with using 8 times EBITDA to get a terminal value. So that's an issue of it. Maybe by the time I get to the terminal year, much similar companies will have different growth. But there's a much more fundamental reason. It goes back to the, yeah, go ahead. In other words, that's why we drew this contrast between value and price, right? I said you can either do an intrinsic valuation of a company based on cash flows, growth, and risk, or you can price the company. And what have you done when you make the terminal value a multiple? You've made your biggest number in intrinsic valuation into a pricing. This is neither fish nor fowl. It's not a DCF. It's not a pricing. I'm not even sure what it is. But as I said, 80% of banking valuations do this because it's easy to play games that makes it eight. In fact, there's a table that's almost pre-produced, I think, at the bottom of these. What will happen to my terminal value if I use 6 times, 8 times, 10 times? The obvious thing is the higher the multiple, the higher the terminal. But you shouldn't be using any of them in the first place. So now let's get to specifics. Let's assume you're looking at a company with 100 million in after-tax operating income. So you're getting to the terminal year. So you're 100 million after-tax operating income. You have no growth expected in perpetuity. You have a cost of capital of 10%. So just a purely mechanical question. If you have 100 million in cash flows in after-tax operating income, I haven't given you cash flows. I've given you a growth rate of 0. That's a clue. And I want you to get terminal value with a 10% cost of capital. What's the terminal value? And I want somebody to explain, reason, say, what do you think the terminal value should be? First, what does it look like I'm not giving you? I've given you earnings, but I'm not giving you net capex and change in working capital and reinvestment. Why do you not need them? No growth, which means no reinvestment. No reinvestment means after-tax operating income becomes your cash flow. You got 100 million in cash flows. Divide by 0.10 because you have no growth. Your terminal value is $1 billion. Everybody agree with that? Okay. Now let's play some magic here. Let's assume that I now tell you that this company can grow 2% a year forever. So I have a question for you. Will my terminal value go up, go down, remain unchanged? It's you can't tell. But first, how many of you think the terminal value will go up? In fact, most people assume if I change the growth rate, the terminal value will go up, right? It looks like the math should work in your favor. In fact, here's what you do. You take the 100 million, divide by 0.10 minus 0.02. It's 1 point. This is magical. You've added $250 million to the value. But what am I missing when I do that? That 2% growth is helping me. But what do I have in the numerator? After-tax operating income, which assumes I don't reinvest any money. Do I have a problem here? I have a giant problem. I'm assuming growth without reinvesting. So how the heck do I assume how much I need to reinvest? What is the missing piece of the puzzle? What do you need to know to estimate how much you need to reinvest? Remember the sustainable growth equation we talked about in steady state? What's growth? It's reinvestment rate times return on capital, right? We play a game. Let's assume a return on capital is 10%. To grow at 2% a year, how much will you need to reinvest? 2% divided by 10% is a 20% reinvestment rate. Your cash flow, instead of being 100 million, will become 80 million because you got to reinvest. What's 80 million divided by 0.08? It's $1 billion still. This is like magic. I put in a 2% growth rate. Nothing happened to my terminal value. You want to put in a 4% growth rate? Be my guest. It'll still be $1 billion. Why? Because I'm assuming that you can earn a return equal to the cost of capital. What if I assumed a return on capital of 5%? So to get a 2% growth rate with a 5% return on capital, how much will I need to reinvest? Come on, 2 divided by 5, you can work it out in your head, is 40%. 40% of 100 million is 40 million. I'll have 60 million in my numerator. I'm going to be in trouble, right? Because my terminal value now will actually decrease as I put in a 2% growth rate. Why? Because my return on capital is less than the cost of capital. People make a big deal about growth rate in perpetuity. That's the big assumption. No, it's not. It's a return on capital that you assume that goes with the growth rate that's going to determine what will happen to your terminal value. And today we'll talk about what to assume about that number because it's one of the inputs I ask you for. In this FCFF simple Ginsus, what will the return on capital be after year 10? You probably say, who knows and who cares? We'll talk about some of the things you want to think about as to whether you should set that return above your cost of capital, equal to the cost of capital, or below your cost of capital. Because ultimately, it's not growth that creates value, it's growth with excess returns. So let's move back to the slides. I think we were on slide 190. Let's see, why not guess. Terminal value slide. I'm very fond of Mexican food, so I'm going to call it the big enchilada. This is the number that you look at a DCF and say, oh my God, that's a big number. So let's dig a little deeper on why we need the terminal value in the first place. Remember what we said at the start of this class, the value of an asset is the present value of the expected cash flows over its lifetime, right? The problem we run into is if you have a company, which in theory could last forever, you can't estimate cash flows forever. So this is a practical problem you run into. I can't estimate cash flows forever. I've got to stop at some point in time. And when I stop at some point in time, I can't assume my company disappears. I'm going to estimate what the value of my company will be when I stop. That's really the challenge you face. That's what a terminal value is trying to compute. So let's think about the ways to compute terminal value. And I've kind of given away the answer with the start of the class test today, which is you can do a liquidation value. Perfectly okay, it's a cash flow. It is appropriate either in public companies that are decaying or declining, or it could also be in private businesses where when the owner dies, the business is going to die with the owner. So you have a liquidation value. Second is a going concern perpetuity. This is the R minus G that we use for perpetuity. To use that equation, though, you got to use a growth rate that's less than or equal to the growth rate of the economy in which you operate. We'll talk about why. It's a math issue, not a finance or an economics issue. That's a going concern assumption of perpetuity. You could also make a going concern assumption where you say, look, I don't want to assume forever. That's too much. I'm going to assume 40 years or 50 years or 80 years and estimate the cash flows over that period. You get a little more leeway in what kind of growth rate you can use when that's the case. And the last, of course, is this exit multiple. This is a pricing. As I said, the first three are all perfectly okay. I think we underutilize liquidation value. We underutilize growing annuities. But we should never be using a pricing in the first place. Revenue, EBITDA, it doesn't matter, earnings, whatever multiple you use, you're making your biggest number in your DCF into a pricing. So really your choice is, do I want to assume a liquidation value or do I want to assume a growth rate beyond year 10? In some cases, you might use a liquidation value. In most of your companies, it's going to give you too low a number because essentially you're shutting your company down. So let's be very clear. Liquidation doesn't mean you're selling the company. You're breaking it up into pieces and selling it on eBay, if that's the way you want to do it. So if I did a liquidation value for Disney, you know what I'd do? I'd dismantle Disneyland and put up Peter Pan ride for sale. Keep it in your backyard. Pay a couple of million. I'm sure there'll be people who pay, but the liquidation value reflects the breaking down of the company, selling off the assets. So let's focus on this growth rate in perpetuity, because that's the form you see most often in valuation. Yeah. It'll give you, for most companies it will, right? Because you're shutting the company down. Microsoft's liquidation value is going to be a fraction of its value as a going concern, especially for businesses which don't have physical assets. I'm not sure what to even liquidate. Maybe brand names, maybe somebody will pay for the Windows name or the Office name. So liquidation value will give you a low, which is part of the reason you tend not to see it with public companies, because usually a business is worth more as a going concern than it isn't. But there are exceptions. I think Bed Bath & Beyond is worth more in liquidation than it is as a going concern. Sell it to get whatever you can for those leases. Maybe people will pay you up. So if you're in a truly declining bad business, liquidation value can exceed your going concern value. But let's look at that equation, right? This is a classic liquidation value equation. You get to year 10, to get the terminal value in year 10, you estimate the cash flows in year 11. Let me repeat that again. To get your terminal value in year 10, you always need cash flows 1 year out. Why? Because that's where present value equations all work. Cash flows to be 1 year past your present value date. Cash flows in year 11 divided by R minus G. Take a look at that equation. You can already see the potential for mischief. You're an analyst, you valued a company, you come up with too low a number. You know what I mean by too low, right? Your managing director expected to see 50, you're stuck at 22. It's late on a Saturday night. and you want to get the 22 to 50. My advice is don't play with the growth rate in year 1 and year 2. It's going to take you far too long to get to 50. Go to your terminal value, take the growth rate. It's right now at 2%. Your discount rate is 8%. Make the 2 go to 3, 3 to 4. And if you leave the cash flows fixed, and that's the magical part, as you move towards your cost of capital, you're going to get what I call Buzz Lightyear valuations. To infinity and beyond. You see, you're right. As G approaches R, what's going to happen to your terminal value? It's going to approach infinity. And you go, G increases above R, God help you, you're beyond infinity. I don't even know what's there, but I don't want to come in there with you. Once in a while, I get a discounted cash flow valuation from somebody say, I got a negative value for my company. I don't know what I'm doing wrong. I've used a 15% growth rate forever for Microsoft, and I keep getting a negative value. I'm not even sure how to respond. If you put a 15% growth rate forever and your discount rate is 8%, of course you're going to get a negative value. There's nothing wrong with the model. There's something wrong with you. Right? I mean, in a sense, you make assumptions that really don't make sense. Of course, you're going to get strange looking numbers. Don't blame the model. It's an inanimate object. It's a mathematical equation. So if you're thinking about growth rate in forever, let's put some limits on it. First, that growth rate cannot exceed the growth rate of the economy in which you operate. Everybody agree with that? This is not economics. It's not finance, it's math. Because, you'd be surprised how many people, when I valued Tesla, the biggest pushback I got was, why are you setting the growth rate at 4% a year forever after year 10? Why don't you set it at 12% a year forever? Tesla is a special company. This has nothing to do with Tesla being a special company. If I let Tesla grow at 12% a year forever in US dollar terms, in an economy growing at 4% a year forever, what's going to happen sooner rather than later? It's going to become the US economy, then globalization. It's going to become the global economy. Then what? Interplanetary travel? With Tesla, you could actually tell a story that they will use SpaceX to launch Teslas into outer space, sell them to Martians. You got to find them first. There are some assumptions in valuation where we can disagree. So if you use a revenue growth rate of 25% for the next 5 years, and I use 15%, that's a difference of opinion. But this is one of those things where there can be no give, right? You're saying, what if I just let the growth rate be just above the growth rate of the economy? Just a little bit. It's like being a little bit pregnant. You're either pregnant or you're not. It's 0 or 1, right? It's not like, it's just a little bit. This is one of those rules you don't want to mess with, because once you start messing with it, it's going to blow up in your face. Yep.
What do you have a company that's like sells in many different markets and
make it, I said the economy in which you operate. I didn't say it's a domestic economy, right? You can make it the global economy then. You're saying, what if I'm in a high growth market like China? What was the growth rate in the Chinese economy 20 years ago? It's about 10, 12%. The most recent projection that Beijing made for the economy, and this is in a sense a high watermark for the growth rate, is now 5%. See, that's terrible. 20 years ago, the Chinese economy was the 7th largest economy in the world. You had room to grow at the expense of other countries. Eventually, your growth rate is going to converge on a global growth rate. No country is ever going to be able to maintain it. It's the same reason a company can't grow at a rate higher than the economy. Countries eventually will hit a wall, not because it's again the math working against you. So eventually, if you want to make the argument that your company is a global company and give it a global real growth rate that might be higher than your domestic real growth rate, which a lot of European companies are doing, right? If Nestle stays in Switzerland, the shrinking population, the aging population, I don't know how much chocolate they can eat. There's only so much you can sell. But by making a global argument, might be able to use a higher real growth rate. So that's your cap. You know, what do you mean cap? Let's say the nominal growth rate is 4%. I've said you can't exceed 4%. Can you be lower than 4%? Can a company? Absolutely. In fact, you could make the argument that mature companies in an economy should grow at a rate less than the growth rate of the economy. And here's what. Remember, there are both growth companies and mature companies in the economy. If every mature company grows at 4%, the growth rate of the economy, then why do all growth companies go for their higher growth? So if you have a sector that's growing at 15%, almost mathematically, there will be other sectors that grow at less than the growth rate of the economy. So if it's 4%, you're okay to use 3, you can use 2, can you use 0% growth? Can you use minus 3% growth forever? Why not? The equation works. You're saying, why would I do that? If you're valuing a tobacco company or a fossil fuel company, what's the story we're telling about both businesses? Tobacco is going to shrink as a business because fewer people are smoking. The smokers are aging. So unless you decide to diversify into cannabis or something else that younger people might smoke, you're kind of looking at a future of shrinking revenues. Fossil fuels with climate change, with whatever you think about the near term, eventually you might make the argument that these companies are going to end up with negative growth rates unless you have a story that tells how your company leaves the space, it's perfectly okay to use a negative growth rate. You say, what does it even mean? When you use a negative growth rate in perpetuity, here's what you do to your company. It peaks in your year 10. And then it shrinks over time gradually to disappear, which actually is the way actual life cycles work, right? It's only in discounted cash flow valuation that every company becomes this huge, mammoth, monstrous company over time, because we assume that every company grows at 3% a year forever. Where do all these gigantic companies coexist in the economy? So be okay using a negative growth rate if any of you are valuing companies where you think, look at the business, say, this is a bad business, it's only going to shrink over time. And finally, remember the big deal we made about consistency? This morning, I got an email. It's almost perfectly timed for this class. It's from an Iranian analyst. You know how difficult it is to value companies in Iran? I mean, there are no markets you can rely on. Inflation is about 20%, he said. And his email basically said, I keep getting really low values for every company I value. And he described what he was doing. He said, I'm using, with the inflation rate, my discount rate is 20, 22, 23%. And he was using the high discount rate. Then when he got to the terminal value stage, he was using a 3% growth rate. And he explained why 3%. He said the long-term growth rate in the Iranian economy is about 3% a year, which actually is not a bad estimate if you're talking about real growth. The 3% was a real growth rate. The discount rates are all nominal growth rates. You mismatch the numbers, you're going to significantly undervalue companies. So what do you think my advice to him was? What are the 2 ways he can fix this? Comes right after the quiz, so you should be able to tell me. I can either make my nominal discount rate into a real discount rate, which will make the 25% into 7 or 8%, even with country risk. Or I can take my 3% growth rate, add the inflation to it, and use an 18% growth. You think an 18% growth rate forever? If you have 18% inflation or 20% inflation, you can have an 18% growth rate forever. Your valuation is not going to blow up because your discount rate is also going to rise for those companies. So people act like this terminal value is somehow set for them. It has a lot more flex than you realize in terms of bringing in the differences across your companies. But here's the challenge you're going to face. I mean, I'm going to ask you what your growth rate is forever starting in 2032. For the entire economy. Do you guys want to actually be sitting there forecasting what the growth rate in nominal terms is going to be for your economy? You think, why? I'll ask some macroeconomists, why are you wasting your time? You know how long it takes macroeconomists to tell you there was a recession? 2 years after the recession has happened. So 2 years ago, there was a recession. Thank you for letting me know. I'll go back and defend myself now. That's how long it takes the NBER, which is the National Bureau of Economic Research, to classify something as a recession. You can ask these guys what growth will be beyond the year 2032. So I've been struggling with a way of estimating growth forever that I don't have to go out and do incredible amounts of research. It's tied to the rest of my valuation. So I'm going to show you what I use, and I'll try to justify it, because when you use it in your DCFs at work, people will say, what's the link between these two numbers? Remember, I want a growth rate in perpetuity after 2032 in the same terms that I've done the valuation. I'm going to use my risk-free rate as my proxy for that growth rate forever. You've already seen me do this when I did implied premiums, so let me back this up. When you look at a risk-free rate in any currency, There are two components to it. There's expected inflation and an expected real interest rate. It's called the Fischer Equation. So I'm not inventing things. That's my risk-free rate. What goes into a nominal growth rate in the economy? Expected inflation and an expected real growth rate. So the two equations, you set them next to each other. One has an expected real interest rate. The other has an expected real growth rate. Do you remember what a real interest rate is? You remember from Econ 101? Usually they give examples like apples. You borrowed 100 apples, and you're going to see in a minute why it's got to be apples and not dollars. And you have to return the apples 1 year from now. You got to return 102 apples as a 2% real interest rate. Real interest rate basically means I'm going to return whatever I borrowed from you with an extra amount on top because I put present consumption over future consumption. That's what a real interest rate is. So let's say I go around promising people 2% real interest rates, but the economy is growing at only 1%. Collectively, we have a problem. Do you see why? Because people are promised to deliver 2% more. The economy is growing only 1%. Where's the extra 1% going to come from? So real interest rates cannot run ahead of real growth rates because sooner or later, the system's going to blow. Real growth rates can be higher than real interest rates in the near term, but over time, even that number is going to converge because over time, the two numbers can't be out of sync. And we're talking about forever here. So they could be out of sync next year, maybe next 5 years, but not forever. You're not convinced, right? So let me give you some numbers to back up why I think the risk-free rate is a good proxy for nominal growth rate. Say I go back all the way to 1954, and I run an experiment. The first part of the experiment, I ask macroeconomists to forecast what growth will look like for the next 10 years. To get the best macroeconomists together, they make a forecast of growth. My alternative is I take the T-bond rate that day and I use it as my forecast for growth for the next 10 years because I remember I said the nominal interest rate is a predictor of growth. Over the last 70 years, the T-bond rate has beaten economists' forecasts on nominal growth as a predictor of growth in the economy. You know why? You ask an economist what growth is going to be, you can make up any number, right? There's no money behind it. The T-bond, you're actually putting real money behind the number. I'll take a money-backed number over a number that somebody spouts off, no matter what their expertise is, every single time. And if you look at this table, you can see that between 1950, if you take the entire time period, there's the 10-year T-bond rate. You take the inflation rate and the real GDP growth rate over the period, you can see it's been slightly higher. But if you break it down, much of that increase came from the first part of the time period, 1954 through 80. The growth ran ahead of risk-free rates since 1980. If you look at the growth rate, it actually, between 81 and 2008 ran below. In 2011 and so you can see that between periods, you can have periods where one runs ahead. But if you look at the periods with high T-bond rates, you get high growth rates. And this is what we talked about in the context of why have interest rates been low for the last decade. It's because you've had low inflation and low real growth. So today, of course, the T-bond rate is 4%. If you ask me what's the nominal growth rate in the US economy going to be for the next 10 years, I'm not going to jump around and ask somebody what, I'm just going to use the 4%. And here's, if none of this has convinced you, let me give you a final reason why I still think you should connect your growth rate in perpetuity to the risk-free rate. It's an issue of consistency. Now, remember that when you get to your terminal value, your growth rate pushes up your cash flows, and your discount rate is what you discount those cash flows at. If I assume a growth rate for the economy that's much higher than the risk-free rate, here's what's going to happen. My cash flows are going to grow 4% a year. I'm going to be using a 1.5% T-bond rate. I can almost guarantee you're going to overvalue a company. And the reason you're overvaluing the company is because you're making internally inconsistent assumptions about the economy in your own equation. In your numerator, you're assuming an economy that's going to grow at 4% in nominal terms. In your denominator, you're assuming an economy that will grow at 1.5%. It's the reason a lot of people had trouble with low risk-free rates over the last decade. The most common pushback I would get is, with these low interest rates, I'm finding everything is very valuable. That shouldn't happen. Because if you tie the growth rate to your risk-free rate, when one is too low, so even if you tell me risk-free rates are too low, the other is going to be too low as well. It basically means that your mistakes will cancel out. So if you think risk-free rates are too low, stick with a low growth rate, it'll cancel out. If you think risk-free rates are too high, stick with a high growth rate, it'll cancel out. By connecting my growth rate to my risk-free rate, I essentially stay consistent. And currency takes care of itself, right? If I am doing my valuation in a high inflation currency, my risk-free rate is 12%, I get a lot more leeway on the growth rate. I can use a 10% growth rate and get away with it because I'm in a high inflation currency. So I know it's a long-winded argument, but it's an argument you're going to have because much of valuation, people make different assumptions about growth in the numerator and growth in the denominator by using risk-free rates that don't match up. Yes?
Couldn't you expect an inflation rate to hit and add like historical GDP growth?
You could, as long as you do it to both. See, that's my point. If you want to do this to the numerator, then what? Your risk-free rate then has to be estimated the same way. You cannot just do this to your numerator and leave your denominator unchanged. So if you want to normalize things, which is what you're doing effectively, then normalize the risk-free rate as well. It seems to me that you're going through a lot of trouble with little effect on value, because if you normalize both, guess what's going to happen? R minus G, right? So if R and G both go up, the canceling effect will basically mean you're not affecting terminal value that much. So why spend your time on an input that's not going to make that much of a difference to your terminal value? So that's the first point. And the reason I emphasize it so much is people are convinced that it's a huge issue that they have to worry about. You'll be amazed at how much time people spend on estimating growth rate in perpetuity. It's got nothing to do with your company. It's got nothing to do with so in a sense, the only place it'll show up is the other inputs. Your growth rate in perpetuity, it doesn't matter whether you're a special company or a not so special company. You don't have much room to run. So let's talk about what happens when your risk-free rate turns negative. And you're going to see what I mean about staying consistent. So the last part of the last decade, risk-free rates turned negative in some currencies. The euro, for instance, had a negative risk-free rate. And people said, you can't do discounted cash flow valuation anymore. And I said, why not? And the argument was, with negative risk-free rates, you're going to get really low cost of capital. Is that true? Absolutely. So here's a valuation of Heineken in September of 2019, when the euro risk-free rate was minus 0.5%. I know some of you are working with negative risk-free rate currencies, so kind of hang in there for this valuation. So the negative risk-free rate, minus 0.5%. You start at the base of minus 0.5%. It's going to push down your cost of equity. It's going to push down your cost of debt. They ended up with a cost of capital of 5.04%. It's good news. Because they have really low, the risk-free rate is negative, they end up with a really low cost of capital. Remember, having a negative risk-free rate doesn't mean you end up with a negative cost of capital. You still have risk premiums and spreads. You're going to end up with it's going to be a really low number. That's a good news. Saying, what's the bad news? Why were risk-free rates low in Europe? Because you had deflation at that point in time, and real growth looked pretty abysmal. Now, when I forecast numbers for Heineken, I've got to keep that in mind, right? The same forces that keep your risk-free rate negative are also the forces that are going to drive your cash flows. So I was conservative in the growth rate that I was estimating. I think the growth rate I estimated was 3.22% a year. But here's the number that when I presented, I actually presented this to an audience where there were 4 people from Heineken's finance group in the audience. And I got to my terminal value. I said, I'm going to give you a minus 0.5% growth rate forever. Remember, the cap is risk-free rate. They freaked out. They said, that's terrible. And I said, you didn't complain with, now you used a negative risk-free rate to come up with your cost of capital, right? If you use a negative risk-free rate to come up with a low cost of capital, this is the other shoe waiting to drop, saying, they said, can we use a 3% growth rate in perpetuity? I said, you can, but here's what you'll need to change that. You want to use a 3% growth rate in perpetuity, what will they need to do to stay consistent? They need to go in and recompute a cost of capital after year 10, using a 3% risk-free rate. And if you do that, then I'm okay with it. This is one of the second to last questions in the FCFF Simple Ginzu spreadsheet. I put it in because in the days of low interest rates, because people say, what if I think T-bond rates are going to go up? I said, that's fine. Then put in a higher T-bond rate, put in a higher growth rate. I can live with that, but you can't change one without thinking about the other. It's internal consistency that gets people, internal inconsistency that gets people into trouble. So don't give up just because risk-free rates are low. Luckily, the promise passed for you because a year ago, people were complaining about how low the T-bond rate is. Notice there's nobody complaining. Today, probably complaining the rate looks a little high. No. Stop complaining about rates. They are what they are. Build them in. Set a growth rate cap based on the same rate. Move on. I want you to think about your company, not about interest rates and inflation and the macro factors. I want you to focus in on the company. Second, don't wait too long to put your company into stable growth. I mean, often your growth rate might be 10%. And when will my company become a mature company? Mature company is a rate that grows, mature company is one that grows at a rate less than or equal to the economy. And also remember, growth has value only if you earn excess returns over and above the cost of capital. So if you think your company is in a comparative business and excess returns are going to disappear after year 3, you might as well stop, right? Growth is not adding value. It's just a mechanical thing you're throwing in. It increases your earnings, but it also increases your reinvestment. The two offset each other. So one of the questions you're looking at when you value a company is, what kind of company am I? What business am I in? What are the competitive advantages? What are the barriers to entry in this business? Remember, I said every number has a story behind it. And that's something you have to make a judgment on your company. So when you look at how long a company can grow, companies with strong and sustainable competitive advantages can have much longer growth periods than companies without those competitive advantages. I mean, that requires some, but I'll give you a couple of examples, right? So you look at a company like Groupon. I remember when it went public, it went with a blaze of glory. It's a high growth company, people attaching high values. I never understood the basis for those valuations. And here's why. I never understood, and I still don't understand what Groupon's competitive advantage is. When they went public, you know what their competitive advantage was? That they found my email before somebody else did. And then they sent me an email saying, I have a deal of the day. And I said, what's going to stop a dozen other companies from sending you a deal of the day? You guys get deal. I get at least a dozen deals of the day today. Groupon's growth rate very quickly faded because it had no barriers to entry. Often we look at past growth, we're dazzled by past growth, but the question you got to ask is, what's special about this company? Be a Kevin O'Leary, right? That's basically, no matter how the growth rate of the company is always convinced that everything is overvalued, that you should never pay for more. But it's a good question to ask, what's special about your company? Don't tell me about growth because that's the easy part. Tell me what makes your company unique. So as you think about growth, I want you to think about how long that'll be. And for some companies, you might say the competitive advantage is strong and sustainable. I'm going to go with 20 years, and that's going to be a special company. And for some companies, you might say it's going to fade in 3 years because that's what's going to determine when you can stop and compute a terminal value. I know in the FCF of McKinsey, you're kind of constrained to 10 years for every company. But remember, you can make your growth rate equal to the growth rate of the economy, the risk-free rate by year 5 and make it a mature company after year 5. So you have the mechanism to do it indirectly in the valuation. Now, when we talked about growth, one of the points I emphasize is growth is not free. You got to reinvest to get growth. And especially in the terminal value calculation, that becomes critical because all the excuses are gone for growth without reinvestment, right? Like what? If I ask you, why is your growth high for the next 3 years? You can talk about becoming more efficient, cutting costs. It's okay for the next 5 years, next 3 years. But when you get to your terminal value calculation, you can't use that argument anymore. Why? Because this is growth forever. So even if you don't use the sustainable growth equation for the high growth period, when you get to terminal value, you have to think about how much you need to reinvest to get the growth rate. And that's basically what the start of the class test made you think about. Is if I bring in a growth rate, how much will I need to reinvest? And how much I need to reinvest will be a function of what kind of return on capital I will earn in perpetuity. So in fact, here I've taken a company and for different returns on capital, computed what the effect will be on terminal value using growth rates from 0 to 3%. Let's take the middle column. When my return on capital is 10%, changing my growth rate has 0 effect on terminal value. If the growth rate is less than 10%, Increasing my growth rate actually lowers terminal value. If my return on capital is greater than 10%, it increases terminal value. You're saying, what's so special about 10%? That's my cost of capital. If my return on capital in stable growth is equal to my cost of capital, you might as well set the growth rate to 0. It's having no effect on your terminal. So this is an assumption I'm asking you to make. And you're saying, what should I base it on? If your company is in a business where it's really difficult to earn more than the cost of capital, automobiles, historically, companies have had a tough time earning more than the cost of capital, competitive businesses. Then when you get to terminal value, you're probably safest assuming return on capital is equal to the cost of capital. If your company is in a bad business, brick and mortar retail, and it insists on growing, then my suggestion is set the return on capital less than the cost of capital, because growth will actually destroy value. But if your company has some special advantages that you think will last a long time, like brand name, consumer products with brand names have huge and sustainable competitive advantages. Technology companies, companies with networking benefits. Then you might set the return on capital above the cost of capital and be okay with it, because you're saying this business is a business where you can maintain excess returns for really long periods. My first book on valuation came out in the late 1980s. And at the same time, until that book came along, you had Ben Graham's security analysis. There weren't any valuation books. But John Wiley, that published my book, also published a book by McKinsey on valuation. They both came out at the same time. And if any of you have seen the McKinsey book on valuation, they use NOPLAT, which is their after-tax operating income, just a different term that they use. And in their terminal value calculation, this might be changed in the more recent edition, the original edition, the terminal value was NOPLAT divided by cost of capital. There was no G in the equation. And I'd get all these emails from people. At that time, you didn't get emails. You had to get snail mail from people reading the book saying, well, I've been reading the McKinsey book, and I noticed that they don't have a G in their terminal value calculation. Can you tell me what? To which my response should have been, why don't you write to McKinsey and ask a question? It's not my book. But actually, if you read the McKinsey book, at least the early editions, they made the assumption, and they still do, I think, in their DCF valuations, that once you become a mature company, you cannot earn more than your cost of capital. That's their definition of a mature company. And once you make that assumption, you see why the G disappears? Because putting in a G is going to have no effect on value. Might as well use a 0 growth rate. So McKinsey's argument, no company can earn more than the cost of capital forever. So we're going to assume, and that's technically true. But McKinsey's own research indicates that they might be on some weak ground on this assumption. There's a magazine called McKinsey Quarterly, which is, you can, if you subscribe to McKinsey, you can actually get it for free. I'd strongly recommend you get it, because they do some really good work that's useful from a pragmatic perspective. And one of the papers in the McKinsey Quarterly looked at two things. One is what happens to growth rates for companies if you track them over time. And they're no surprise, as you track companies' growth rates over time, they tend to decrease towards the growth rate of the economy. So we're backing for that. But they also look at what happens to companies' returns on capital if you track them over time. And guess what? If you look at returns on capital, they're much more persistent. In other words, you take a company with a 15% return on capital, you track it over time, you don't see the return on capital drifting down that fast to the cost of capital. That's actually evidence against the McKinsey practice of assuming every company. So I'm not saying every company should assume above the cost of capital, but you should be looking at the persistence of return on capital in your company. If it consistently earns 18, 20, 22%, I would say, you know what, give it a high return on capital in terminal value above the cost of capital, because there's something that this company has, some competitive advantage that's not going to fade that quickly. Now, of course, as I said, this is terminal values where people do some really absurd things and get away with it. So let's say it's a year and a half. I think most of you are juniors, right? You're not graduating at the end of this year. No. So a year and 3 months from now, you're graduating. You've ended up in a discounted cash flow valuation job at a bank, at a consulting firm. This analyst comes across and he says, you know what, stable growth. And I'm going to list out the things, and this is not uncommon. Many DCFs, you'll see this. You say, Now I'm going to assume that a company, mature companies, CapEx will offset depreciation. They'll call it maintenance CapEx or something like that. CapEx offsets depreciation. So what's net CapEx going to be? Zero. There are no working capital needs, which means working capital change is zero. What's 0 plus 0? 0. So you have a 0 reinvestment rate. And now comes the magical part. They'll say, but the company can grow at the inflation rate still. You see the logic here, right? Because you're growing at the inflation rate, you don't need to build additional capacity. And because you don't need to build additional capacity, why do you need reinvestment? There's something wrong with this logic. And I want you to tell me what that is, because it sounds awfully alluring, right? You're just having inflation growth. You don't need to produce more units. So why would I need net CapEx? What is wrong with this argument? Because that basically means you can use a 2% growth rate in perpetuity with 0 reinvestment. What does net CapEx do? You take old machines and you replace them with newer machines, right? So even if you maintain a factory, you're basically replacing old equipment with new equipment. You assumed a 2% inflation rate when you did your revenues, right? So if you're being consistent, when you take that $1 million machine from 10 years ago and you replace it with a new machine today, guess what? It's going to cost you more to replace it. So even though you're maintaining capacity in a world with inflation, maintaining capacity will require a net cap. There is no escape hatch here. You want to put in growth, you need to think about reinvestment. I don't care whether the growth is inflation growth or it's real growth. The reinvestment is going to come no matter what the reason is for your growth rate. It's just going to take a different form. So that's a sleight of hand you will see that many analysts use is, I'm a mature company, I have a 2% growth rate, but because I'm a mature company growing at the inflation rate, I don't need net CapEx. I don't need a change in working capital. Your answer is no way. If you want a 2% growth rate, you need to think about reinvestment. You can make an argument that replacing machines is a higher return on capital project. I'm willing to give you a 20% return on capital if need be, but I'm not going to assume you can get away without reinvesting money. So let's see where we are. You get to perpetual growth, make sure your growth rate does not exceed the growth rate of the economy. Second, we said, don't wait too long to make your company a mature growth company. Third, make sure you're reinvesting enough to sustain your growth rate. And final point to remember is, if you're going to make your company a mature company, give it the characteristics of a mature company. See, what are you talking about? Let's say, any of you valuing young money-losing companies? Okay. So you have a young money-losing company. Just give me a sense of numbers. Are you going to end up with a high cost of capital when you start the valuation or a low cost of capital? Young money-losing company when you start. You're going to end up with a high cost of capital. Why? Because they're risky. They often are a niche business. They don't have much debt. It's all equity funded. The equity might be risky. High cost of capital. In your spreadsheet, I'm not saying you've done the valuation. What do you hope to do to your young money-losing company? First, you want to make small into large revenues. You're going to make the money losing into money making, which I'm not going to, I mean, that's the whole point of valuation. But as your company gets larger and becomes a money making company, what should happen to its cost of capital? It should decrease towards that. In other words, if you keep your cost of capital at 15%, which is what you have in year one, and you make your company into a money making bigger company, you're being internally consistent. You're fighting your own story. So here's what I would expect to see with your young growth company. You might start at 15%, but as your company gets bigger and more profitable, I'd expect the 15% to drift down towards a cost of capital of the average company. In fact, that's a default built into your spreadsheet. If you don't pick a number, I will push your cost of capital down over time, or push it up over time from either direction towards the median cost of capital of a typical company. So as your company matures, I'd expect its cost of capital to approach that of a typical company. What will happen to its reinvestment rate as you go through time? Your growth is decreasing, so you should reinvest less. So I'd expect your reinvestment to change. Even the return on capital, when you start off, you might have a niche business, you might earn a great return on capital, but over time, as you get bigger, that number is, each of the numbers we think about in valuation, you get another shot when you get to stable growth. That's why I ask you to revisit those numbers rather than taking today's numbers, because this is 10 years out. It has the same name as your company today, but it's a very different company. So internal consistency basically means adjusting your numbers to make them more reflective of the company that you have on your spreadsheet, a low growth, high margin company. Which is one reason if you ever see a young company valuation with one cost of capital as a discount rate over time, you already should be skeptical about the valuation because that is not internally consistent to tell me that your company is going to go from high growth to low growth, from money losing to money making, but leave the cost of capital at whatever it is. So now let's bring it all together. We've talked about all of the inputs in valuation. We started with discount rates and we moved to cash flows and we talked about growth rates. Basically, all of the numbers that go into DCF for that, right? So here comes the last part. If you are building your own model, I've done this work for you, but I'm going to give you a sense if you are building your own model, how would you design the right model for your company? So let's start with the first choice you have to make. You can either value the equity in the business or you can value the business. Remember, you talked about two. About 90% of my valuations are value the business, only 10% are equity valuations. Let me explain why. When you have in the cases when you value equity are the cases where you don't have a choice. Valuing a bank, if you saw my JP Morgan valuation, I value the equity because you can't value the business. Because debt to a bank is not really a source of capital, it's raw material. So some cases you have no choice. But when you make that choice between valuing equity of the firm, one of the things you might want to look at is remember, if you do it right, you get the same value using both approaches, right? So it's a pragmatic question, which is easier to do? So let's think about it. To value equity, I need free cash flows to equity. Free cash flows to equity are after debt payments. To value the firm, I need pre-debt cash flows. When you have a company, if you remember the free cash flow to equity calculation, there was a shortcut where you could use to get to free cash flow to equity. You multiplied the net cap. That shortcut worked only if you had a mature company with a stable debt ratio. If you have a mature company with a stable debt ratio, it's equally easy to estimate free cash flow to equity or free cash flow to the firm. But let's say you're a firm that has no debt today, but expects to be at a 30% debt ratio 10 years from now. It's easy to adjust the cost of capital with changing debt ratios, but to adjust the cash flows, you got to estimate how much debt is going to be raised each year, how much debt is going to be repaid. It's much more difficult estimating free cash flows to equity when leverage is changing than it is to estimate discount rates. So here's the shortcut. If you're looking at your firm and saying it has a debt ratio of 10%, I have no idea what's going to happen to it over time, or it's going to increase over time, then stick with a firm valuation. It's easy to get the cash flows. It's easier to adjust your cost of capital changing debt ratios. But if you have a mature firm where the debt ratio has been pretty stable, then you're indifferent between the two. If you are in any doubt, go with the firm valuation. So if you're in any doubt at all, that's why 90% of my valuations become firm valuations. But if you decide to go the equity route, what are the choices you have? What are the two things you can do? You can use the dividend discount model, right? Where you just take whatever the company pays out, or you can estimate your free cash flow to equity potential dividend. Again, I'll make it easy. If you can estimate free cash flow to equity, do not use the dividend discount model. I do not want to see any of you using a dividend discount model in a manufacturing company or a service company. You can estimate free cash flow to equity. Free cash flow to equity is what you can actually pay out. Why focus on this artificial number that companies actually do? Saying, when would I ever use the dividend discount model when you cannot estimate free cash flow to equity? When will you not be able to estimate free cash flow to equity? Think of what you need to get to free cash flow to equity. You start with net income, then you subtract out net capex, and you subtract out change in working capital. For most manufacturing companies, you can get those. But for a bank, what is net capex? What is change in working capital? The dividend discount model's last bastion was financial service firms. And part of the reason people used it was they threw up their hands and said, I don't know what the free cash flow to equity is. Later in this class, I'll give you a way of estimating free cash flows to equity for a bank. But for the moment, if you're valuing a bank or you're valuing a financial service company, that's a one place where you use a dividend discount model. I'm going to let it go for the moment because you really are doing it because you cannot estimate free cash flows to equity. So you pick the cash flow to discount and you basically decided between the two models. Once you pick between equity and firm, your discount rate gets picked for you, right? Because if you decide to discount dividends of free cash flow to equity, your discount rate has to be the cost of equity. If you're discounting pre-debt cash flows, your discount rate is the cost of capital. So it's not like you have a choice once you pick what cash flow to discount. And then you can do sub-tests, right? If you're doing everything in real terms, you can use a real discount rate. If you're doing it in dollar terms, so make sure you're being internally consistent. So when you think about when you think about what model, let me give you a very broad template for deciding what to do with your company. If you have a large firm that is growing at a rate less than or equal to the economy, you're valuing Verizon. If any of you are valuing Verizon, I'm not prejudging you. It's likely that you're going to get a growth rate less than or equal to the growth rate of the economy. It's constrained from growing much faster. The old regulated monopolies used to have constraints on them. Or is a character, but it also has to have the characteristics of a mature firm. Like what? Its cost of capital should be pretty close to the average. It should be, not at a zero debt ratio. So in a sense, if everything has settled in, there's no reason why you cannot value a company with three numbers. The expected cash flow next year, the cost of capital and the growth rate. Just use the terminal value equation today. There's no need to project our 10 years of numbers if nothing is changing. Will that be possible for some of your companies? You might think you hit pay dirt if you found one of these companies. And you have it pay dirt in terms of how much work is involved in evaluation, but this is a valuation where you learn very little beyond doing it. But do it and pick another company to actually do a DCF. If you have a company that is large and growing at a rate higher than the growth rate of the economy by a little bit more, 5, 6, 7, 8%. A lot of larger companies like Coca-Cola, you could argue, are not quite stable yet, but they're getting close to that point. Then I think you should at least have a window where you allow the company to grow at a rate faster than the economy, 3 years, 5 years. And then you could put your company into stable growth. I call these two-stage models, a stage of high growth, and then you become a mature company. More generically, though, if you have a company that's growing at 20 or 30%, you don't want to make that growth rate go to the growth rate of the economy in year 6, because that's a big. So what you do is you introduce a transition period. It's a fancy word for, I'm going to get them from 20% to 3% over 5 years or 10 years. Generically, every discounted cash flow model, that's what you're doing. You're either a mature company already, you have a 2-stage model, 3-stage model. You can even have an end-stage model. You have a growth rate that varies every year. Eventually, in all of these models, you end up with stable growth. But the question is how you get there. So I'm going to close the picture. I think of, yeah.
But if you have a large company that's been growing at below the country growth rate, but it's taking on a risky venture.
And you put in the high growth, but then bring in all the characteristics, right? Bring in the costs of being in that risky venture into your reinvestment. What it'll mean is you'll be less able to use historical numbers in your forecast. Their historical reinvestment rate, their historical return on capital, their historical cost of capital all have to get reassessed because this company is changing its business model. So there you're going to introduce growth, but that growth might be more likely to destroy value than add value if they're entering a business that they have no business entering into. So I think of discounted cash flow models as Legos. You've ever played with Legos, think of 3 Lego boxes. You got the discount rate box, the cash flow box, the growth pattern box, and you're trying to fit them together. Every DCF model is a combination of choices of what cash flows you're discounting, dividends, free cash flow to equity, or free cash flow to the firm. What discount rate goes, and remember, some Lego pieces don't fit together, so you can't take a cost of equity and force it on a pre-debt cash flow. And finally, what growth pattern do you pick for your company? Now, that's why I've never understood people who claim proprietary dividend discount models. Sanford Bernstein, which is a well-known research firm, for the longest time had patented a 2-stage dividend discount model. Shows you can patent pretty much anything. Then what the heck did you patent? That you invented dividends, invented 2 stages? No, there's nothing patentable about a discounted cash flow model. It's basic mechanics. But people who invent, there are all these variants. I've invented a new DCF model. No, you haven't. You just put the Lego pieces together in a different way. Everything here is building off the same ingredients. So now, you think you're done, right? You got cash flows, you got the discount rate. Let's say you've done everything we've done so far. You got the terminal value, you got it all right. You come up with the present value. You say, thank God I'm done. This is where the real damage gets done. I'm going to call it tying up loose ends. Now, you know how academia works? Let me tell you, I work incredibly hard. They make me work like 4.5 hours a week for like 38 weeks. They give me only 17 weeks off every year, or 16 weeks. And because I work so incredibly hard, every 7th year, I get the entire year off with pay. It's called a sabbatical. You feel sorry for me already, right? So I've had over my law, because I've been here 38 years, I've had 5 sabbaticals. And usually people have big plans for their sabbaticals. They're going to write a book, they're going to do papers. This is, I think, 2007 or 2008, a sabbatical was coming up. And I had a singular objective. I said, I'm going to spend 365 days doing absolutely nothing. I want to wake up every day with a to-do list with nothing to do. So I was a little ostentatious about it. I went to Staples and I bought one of those boards with to-dos on them. I got home, I stuck it over my corner of the home. I didn't have an actual office, where I put it up there. And as my kids came down, they were all at home still going to school. As they came down to go to school, I pointed to my to-do list and said, look, nothing to do today. God pissed them off no end, but they left. Then I made my fatal mistake. My wife came down the stairs. They said, hon, I have nothing to do today. She said, really, why don't you take the dog for a walk? So I took the dog for a walk. I come back, there's something on my to-do list. So what the heck is this? My plans have been broken on day 1. Said, pick up bok choy at the grocery store. I had no idea what bok choy even was. I was too embarrassed to ask. I spent like 2 hours wandering around. Finally, I found it. It's this ugly looking cabbage. Tastes really good. I come back home, there's another item on the to-do list, pick up kids from school. So after about the 3rd or 4th item that showed up on my to-do list, I said, I need something to do to keep my wife off my to-do list. I'm really desperate. So coincidentally, I get an email from the editor of CFA magazine, which I've never heard of. I'd never heard of the editor. He said, can you write a 1-page article for the CFA magazine? My first reaction would be, I want nothing to do. But then I remembered I needed things to do to keep my wife. So I said, okay. And then I put in big words, writing 1-page article for CFA magazine, cannot pick up bok choy kids, et cetera, et cetera, et cetera. And I spent the next week writing this 1-page article. And I tell you, it's the only thing I've ever written in valuation that's got me hate mail. You know how difficult it is to get hate mail in valuation? Nobody's ever said, I hate you for using bottom-up betas. They don't feel strongly enough about it. But part of the reason I got hate mail was the title of the article was Stop the Garnishing. And I was talking about the practice in valuation where people who do a valuation, then add 20% for control, knock off 25% for liquidity. And I said, if you do this, and I might have used the word arbitrary to describe these premiums and discounts, you're going to end up wherever you wanted to in the first place because you're just going to find a mechanical way to get there. And I get this wave of hate mail. And then I get this one email that actually made a good point. They said, and mostly these are from private company appraisers where there's a lot of discounting and premium. They said, if you don't like the way we're doing this in valuation, why don't you come up with a better way? I said, you're right. I have 11 months left in my sabbatical. Here's what I'm going to do. Every month, I'm going to pick up a loose end, something that people attach a premium or a discount to, and talk about how I would go about valuing that loose end. So control. Everybody attaches a 20% premium. You can see where you get it. But if you're doing this right, how would you value control? So month 3, liquidity. Everybody talks about liquidity. You knock off 25% from value. Why 25%? Why not 15? Why not 35? So each month I picked a different loose end. So there went my plan to do nothing for a year. But it's actually 1/2 of one of my valuation books, The Modern Valuation, which is really a practitioner book for private appraisers. The second half of the book is all about all these loose ends. So I'm going to give you a very speedy run through on some of these loose ends. So here are some of the things I want to talk about. I want to talk about the practice we have in valuation after you've done your DCF valuation of adding on cash and marketable securities. Standard practice, right? You do a discounted cash flow valuation, you add cash on. I'm going to ask a question. Are there conditions where you might discount cash in the hands of some companies or attach a premium? I want you to start thinking about that. And why would you do that? I want to talk about cross holdings, where you hold 3%, 5%, 10% of another company. In a perfect world, how would you value cross holdings? In the world we're in, where information is not always available, what do you do about cross holdings? What about other stuff? What if my company has vacant real estate in Manhattan? Can you even have vacant real estate? But let's say you have land in Manhattan that you're not using, but you own it. Should I be adding that on to my DCF valuation? I want to talk about, hey, what's the value of control in a world where control actually matters? So in other words, each of these, I'm going to go back and talk about what practitioners do and what we might think about doing differently to get a better judgment on what's what. So I want to start with cash. We know the conventional practice with cash is $100 in cash. How much is it worth? Don't play games. It's worth $100. We're kind of sloppy sometimes in discounted cash flow valuation. We ask you, have you valued cash? It's amazing how often, I have no idea. But in the way we do this is we keep cash separate from our operating assets. We get the free cash for the firm. We discount the cost of capital. We add cash at the end because we've kept it separate. When you're doing a free cash or equity valuation, all bets are off, right? If you start with net income, in a sense, you've already incorporated cash into your cash flows. You can't add cash on because then you might be double counting cash. So we are sloppy, but we think we know what to do. Cash is cash. I'm going to add the value of cash. So I'm going to start with a question. I want you to think about this from an instinctive standpoint. Don't think in terms of models. I'm going to show you three companies. Three companies have the same enterprise value. So I've got the same DCF value by discounting free cash for the firm at the cost of capital. All three have $100 million in cash in hand. And your job is to value the cash. So forget about the enterprise value. Let's suppose that's right. They all have 100 million cash. Seems like a stupid question. They all have 100 million in cash. Should be worth 100 million in every company. Let me add some details about these three companies. Company A is a US-based company, earns a return on capital of 10%. Its cost of capital is 10%. Company B is also a US-based company, has a return on capital of 5% and a cost of capital of 10%. Company C is an Argentine company, and it's a return on capital of 22% and a cost of capital of 12%. I'm going to argue that in one of these three companies, cash is a neutral asset. You know what I mean by a neutral asset? 100 million cash is going to be valued at 100 million. In one of these three companies, I'm going to attach a discount to the cash. In one of these three companies, I'm going to attach a premium to the cash. Let's start with the easy one. In which of these three companies is cash most likely to be a neutral asset? And what is it about A that makes it a neutral asset? It's a block company. What do block companies do? They don't help you. They don't hurt you. They kind of run in place. But before you complain about block companies, there are fates far worse than investing in a block company. So let me ask you about the company where you're most likely to attach a discount to the cash and why. Which of these three companies are you most likely to attach a discount to the cash and why? I'm going to see if anybody want to give me a shot? Go ahead. Why, Yuki? You don't trust those Argentines, right? They kind of drink and they play games. But is it, do you think it's C, or what is it about C that worries you? But they're earning a return, so they have a higher cost of capital. They're earning a return on capital that exceeds it. So unless you say, I don't trust Argentine accounting, which might be a legitimate target, they're still earning more than the cost of capital. They're finding good projects, even though they're in a risky part of the world, right? So it kind of gives you. So
I would see as well, but because if you're getting a higher return on your capital than you, don't you have put that cash in?
You're assuming that there are projects out there. Apple earns 35% return on capital. Its cost of capital is 10%. Why can't it keep taking projects? Because it's not like they have an infinite number of projects that return on capital, right? What is it about company B that should bother you? They have a history of stupidity. You know what you're doing? You're attaching a stupidity discount. You're saying these managers are so stupid that if I give them 100 million in cash, guess what they're going to find? They're going to find more bad investments. I know it's a very cynical perspective, but it's a realistic one. Companies that have a history of taking bad investments are not going to magically stop. So you're discounting the cash for the fact that you don't trust these guys with your cash. Company C, I'll tell you why I might attach a premium. I should have put it in some other market other than Argentina. I'll tell you in a minute why. Normally, in traditional corporate finance, no company needs a cash balance. You know why? If you have a great project, In utopian corporate finance, what do we assume you can do? Go out and raise capital, take the project. What's the big deal? So in markets where capital is always easy and accessible, companies don't need to maintain cash balances. Do you see why I picked Argentina as my company then? In the last 20 years, there have been at least 5 times when Argentine capital markets have completely frozen up. Not just equity markets, but banks stop lending money. You're in a crisis. Can you see the advantage of having a cash balance in a country like Argentina? Because in that crisis, what does that cash balance allow you to do now? Not just survive through the crisis, but gives you a strategic weapon you can use to buy other companies' assets because those companies are desperate for cash. You might attach a premium to the cash because cash becomes a useful weapon, allows you to survive. And it's not just across countries, like a young company with a big cash balance. It's a good thing to have a cash balance because what do you worry about? All your value is in the future, but if you don't make it to year 3, you're never going to see it. Cash might actually work in your favor. Mistake I made was I made it in an Argentine company. I was in Brazil and I gave 300 Brazilians in a room this example. I think 250 of them picked the third companies here. I said, why? Turned out that Brazil had lost to Argentina in a soccer match the previous weekend. They were really pissed off. They said, you can't trust those Argentines. It's the cultural fights playing out, soccer battles being lost here. But you can see why the value of $1 in cash can vary across. So when you think about why you discount cash, it's not because cash earns a low rate of return. I've heard analysts complain, oh, cash is a bad investment. Cash is a neutral investment. Cash invested in T-bills or commercial paper is a 0 net present value investment. Taking that cash and taking a project that makes 7% might actually make you worse off if the cost of capital on that project is 9%. It's what you do with the cash that terrifies me. And in the hands of some managers, you can see why I worry. So here's for the longest time, people have talked about this, but there was no evidence to back it up because people said, do markets actually do this? Do they actually discount cash? Here's some evidence that they do. It's actually from perhaps one of the most creative studies I've ever seen. What the study looked at was how much is $1 in cash in the hands of a US company valued at by the market. I'll start with the good news. Across all companies, $1 in cash was valued at $1.03. Now, you know what's roughly $1. You know why that's good news, right? Because that's what we do in every DCF. We add the entire cash balance. But when they looked at mature companies with negative excess returns, you know what I mean by negative excess returns? They're like company B. They earn less than the cost of capital. $1 in cash is valued at 69 cents, a 31% discount. You're a company with a bad history of taking projects. You have 10 billion in cash. The market acts like you have only 6.9 billion. You guys have heard of Carl Icahn, right? Carl Icahn is not the deepest thinker on the face of the earth. It's a one-trick pony. There's a classic Icahn target. He picks a target, says, you have too much cash, give me the cash. You see, how did he get so rich? He picks the right companies. Do you see why targeting these mature companies where the market is discounting the cash gives you almost instantaneous payoff? Because you return the cash, what happens to the discount? It's gone. If people don't trust you with the cash, holding on to the cash will actually mean you get a lower value. All you need to do is give back the cash, buybacks, dividends, I don't care. The discount disappears. If you pick a high growth companies that earn more than their cost of capital, you actually find that on average, these companies, $1 in cash is valued at $1.22. So if you're valuing a young company, it's a big cash balance. That's not a bad thing. It might allow them to survive the next downturn, allow them to survive to get to year 3, year 4, year 5, which is when the magical things happen, right? Margins improve, growth rates go up. So there's nothing I want you to do specifically now about cash balances, but if you have a company where a big chunk of its value comes from its cash balance, there are companies out there where 20% of the value, Nintendo for the longest time, half the value of Nintendo came from its cash balance. Then you might want to stop and ask, is this the kind of company where the market doesn't trust the company with the cash? Because when you find the company to be undervalued, it might just be because the big cash balance is being discounted by the company. And unless you have a Carl Icahn on the horizon, that discount will not be triggered for you. which makes you less likely to invest in a Japanese company than in a US company, because that kind of activism is more difficult in Japan than it is. It'll make you less likely to invest in a company with 2 classes of shares, because there again, it's going to be much more difficult to get the company to do the right thing. We close with the example, and I'll build on this further. So we discount cash because cash is you expect cash to actually earn a rate of return less than the cost of capital. You've heard of, everybody here is, I'm sure has heard of mutual funds. Mutual funds is collections of stock. Most of the mutual funds out there are open-end mutual funds. What does that mean? You send money to Fidelity Magellan, the fund itself grows, and you basically get whatever the value of the fund is divided by the number of units. So basically the net asset value is whatever the market value of the securities is divided by the number of people in the fund. That's a traditional fund. There's a subset of mutual funds called closed-end mutual funds. These funds actually trade in the market as companies. So they're companies and all of their assets are actually publicly traded equities. This should be the easiest of all companies to value, right? They're all publicly traded equities. If nothing else, you can take the market cap of each of those equities, add them up. And there's the value of these companies should trade at roughly that number, right? A typical closed-end fund trades at a discount of about 15 to 20% on its on that market value of the securities that it owns. And this in corporate finance, a lot of papers, the papers are all titled the closed-end fund anomaly, the closed-end fund puzzle. You see why it's labeled a puzzle, right? If your market value of the securities you own is 100 million, you trade at 80 million as a market cap. Seems like an easy way to make money. And what should you do to make money? Buy the shares at 80 million, assuming you don't push it up. Right after you buy all of the shares, you liquidate the company, which you're allowed to do as the owner of the company. You'll get 100 million. You should be able to claim the $20 million difference. So that's the puzzle. Why do closed-end funds continue to exist? Why don't people just buy them and liquidate them? And about 20% of closed-end funds do get liquidated, but 80% of them persist. So next class, when we start, we're going to talk about why do closed-end funds usually trade at a discount? Why might they sometimes trade at a premium? And it's going to give you a window into Berkshire Hathaway, which is an insurance company with a closed-end fund that we can talk about.
Okay.
Not that they don't have, if you're consistent with growth. If you're not.
Where's the
It's got nothing to do with interest rates. Basically, it's the fact that interest rates change now. The present value effect will be greater. It's supposed to be a value company. It's a pure present value, which means holding all its constant, high growth companies should be more affected by increasing by interest rate fluctuations. Then so the duration we're talking about here, you do your DCF and you look at where your cash flows come in, you get negative cash flows are coming, big cash flows companies. So the longer duration activity. This the key word is keeping all of its constant. With a bond, it's automatic. But with equity, because your numerator can also change with inflation, it's kind of a qualified effect. If you hold your cash flows fixed and you change it, of course, high growth companies are going to be affected more. So what are the high growth companies that more price something than low growth companies? We introduced and that's why technology companies are not as, I think that's why it's too surface.
So he's just getting the other stuff. We don't know if we know where we're gonna be.
And these low duration.
They're
I would
not,
argue that actually utilities.
they're gonna be sitting in chairs. They're bringing the chairs out now.
the
say those, they'd be
regulated.
sitting in those shares.
Okay.
So I would say the regulated value is pretty.
For the house.
but,
Right.
Which will.
Starting with what pricing power, how easy can this company pass through it? Because at the moment,
You get to pass
if I
it,
can
if that
pass
doesn't work.
inflation through, then inflation going up will have no effect on that. No matter how low the demand, because everything gets passed through. So it's more about pricing.
That's the factors that value that we're talking about. We're assuming that creative.
Once you get into it, I'd take a stand. Having a longer duration makes it riskier. to be a
Well,
reasonable
he's one of them,
No, I know.
That's
That's
what
Matt.
it shows.
But they have the other mic on
That's
him.
the argument here.
Hey, Matt. So, you know, Bo, you want to put a lavalier